Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, May 9th. Boy, things quieted down a little bit this week. We even had a little disappearance of all of the Peter and the Wolf type characters that we've seen in the media or read over the last 2 months. You know the joke I say from time to time. It's awfully tough to bet on the end of the world, because how are you going to collect? Well, we saw some of that volatility start to subside. And in terms of markets, that's just what we needed. Some of this backing and filling had that steep drop and a sharp rally. Now we've gotten back to a spot where it may naturally be a little more difficult to put a sustained run in. And the reason why is we're at the spot where we really broke down from. You know, that 5,700 area in the S&P. Maybe take a little time to repair before we go higher. The way we're playing it, and we've been fairly transparent in this, is that this year we will see a market higher dose of volatility versus the last couple of years. And we lean on history for that. If markets are down through April, it foretold the rest of the year being more volatile. It doesn't mean that you couldn't make money, and it didn't mean that the markets didn't end up higher on the year, but they were more volatile. And the reason is common sense when we think about it. The reason the market's down through April is there's some headaches out there, and they don't get solved overnight. But markets do price in different levels of asset classes and slowly starting to price in equities for a worst case scenario, or perhaps for a scenario that's not as bad as feared. And that's what we've seen the last couple of weeks. So for the angst that's been out there, I wanted to bring up a quick chart just so we can set ourselves at where we are on May 9th, the second week of May. You know, the S&P down, let's round up and call it down 4% year to date. You know, it's a mild number in terms of net drawdown. We see that kind of drawdown annually, multiple times. So that 10% area that we flirted with back, 3 and 4 weeks ago, post Trump's Rose Garden exhibition, that started to solve itself. And now what we'll do is look for spots, industries, sectors that we can put a little bit of cash to work. We're down to tag ends in our domestic portfolios. We have a little bit internationally. You know, for the volatility that we saw, I thought we traded these markets pretty well. For clients to go back through their accounts and think about the trades we did in January when the market was ripping, we were letting go of a little bit of stock. We were selling into that rip. That gave us that little cushion, not a large cushion, but a 10, 11, 12, upwards of 13% cash cushion in our primary strategies heading into February, March, and some of the headaches of April. We put that back to work. We certainly didn't always catch the bottom dollar. A couple times we got lucky and got awfully close. But we're fairly close to fully invested in our equity accounts. If we continue to move higher from here, I wouldn't be surprised that we start to pare back some of that equity exposure on the thought that volatility will be with us this year. So a lot of fun. Markets with volatility are enjoyable because they give you opportunity. And we'll follow on that path over these next couple of quarters. You've got the Moose on deck. Plenty of good information out of the bond market. We'll see what he has to say. Stick with us.
Thanks, Matt. We're filming on Thursday because I'm on the road Friday. This week in bonds, a general rise across the board in yields, 7 or 8 basis points on the Treasury yield curve. You know, 10-year bond is around a 438. 30-year bond is around a 487. What's the market doing? It's preparing itself for next week. Next week, we get the CPI numbers and the PPI numbers, and it's important because these will be the first inflation numbers that we've seen that include some of the tariffs that have gone in. That's important. Last month, you had declines in CPI and PPI. We certainly don't expect that. We expect numbers maybe in the 0.3 area. It'll be important for the market to be able to start to digest this data. Jay Powell this week, what did they do? They used the word wait. They did nothing. Fed fund stays at 4.25 to 4.5. They're waiting to see what happens. The backdrop to the bigger economic picture continues to be slowdowns in different areas. We've talked about it ad nauseum. We still think that's the rule. We think in the end that the slower growth probably overwhelms any inflation numbers that come out of tariffs. Depends on how many tariffs are out there, right? We've seen the president kind of pull back in a lot of areas. Today he's announcing a deal with a partnership with England. So, there's a lot of bobbing and weaving going on, and I think the bond market, when it sees a lot of bobbing and weaving, gives you a little more yield as a cushion, and you've seen that. Muni market didn't need nearly as much cushion. That was only up a couple of basis points across the board this week. Most importantly, deals very well subscribed for, 6, 7, 8 times. So that patina of fear that was in the bond market just a few weeks ago, over taxes, over the volatility of the Treasury market, that has gone away, and you're seeing good participation in the muni market. And that is very welcome because we think muni bonds are very cheap and should continue to improve as we go on and into the summer. Clearly, we'll have more to tell you next week. Big news today is we got an American Pope. It doesn't mean a darn thing for any markets, but it's fun to see.
Thanks, Moose. Everybody enjoy the weekend.